Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to the bigger picture. Me, Ryan Huang. We're taking a look at all the news coming through on the market front. We have tariffs in the backdrop. The latest is the US and China have concluded their discussions without an extension to their tariff pause. So then something that, according to some spokespeople, Donald Trump will have to figure out, and more details to come. And also, MAS, the Monetary Authority of Singapore, this morning has kept its monetary policy steady. So what does that mean as it warns about slower growth ahead? Let's check in now with Francis Tan. He is the Chief Strategist for Asia at Indosuez Wealth Management. Francis, good morning. How are you doing this week?
Good morning. Good morning, Ryan. Everything's okay over here.
All
Thank
right.
you.
Okay, and great to hear because it's been quite a busy week and going to be a busy one as we count down towards the tariff deadline, August the 1st. Walk us through what's been on your radar this week as we look at all the tariff news flowing in.
Well, certainly. I mean, there are two things on my radar right now. One is the real economic fundamentals that the world is going through. This is quite an interesting week because we do have monetary policies coming out from, of course, earlier Singapore, and this evening we're going to have it from the US, and we're also going to see it from the BOJ as well.
That's right.
Some key central banks reacting to where they see the economic fundamentals is. But that's only one thing on my radar. The second thing on my radar is how asset prices or asset classes are reacting to the expectations of the fundamental data in the months ahead. And from the equities prices that we are seeing, particularly from the US, it seems that they're striking off any form of concern that policymakers, central bankers have for the second half of this year, where they repeatedly warn that it could be a slower second half than the first half.
That's right. Let's talk about that pricing in of expectations, starting with the MAS. So looking at the latest announcement this morning, first you have the policy stance, no changes. That's actually a bit of a split decision according to the analyst community. And looking at what we have here in terms of the outlook, they warn that GDP growth is projected to moderate in the second half of 2025 from its strong pace in the first half. And trade-related sectors should see some pullback. Walk us through what sort of slowdown you're expecting and how that will translate into the markets.
Certainly. So the slowdown will come in two forms. The first slowdown will what we call the second half comparing to the first half. Now, the MAS and as well as many policymakers in the world are saying that, the first half came up as to be a stronger half than everyone has expected, mainly because of the front-loading of exports by the rest of the world, especially towards to the US before the tariff or the truce is over. So that's the first thing. So in the first half, imagine factories around the world running at top speed, sending out goods as fast as possible in order to prevent themselves from dropping into the slower demand when tariff sets in. So everyone was rushing. So if we compare on a half basis, the second half, that impact could be over. That's number one. Number two is that because of the uncertainties, we don't really know, including us in Singapore, how much tariff eventually will the US levy against us and the rest of the world. So if that comes on the heavier side, that means higher tariffs than expected, then we are likely to see a more negative export numbers coming for the second half and even beyond. So these are two forces at play, and that certainly is causing some prudence or concerns by policymakers to still want to preempt that the second half could be slower.
That's right.
But looking at how fast the first half has been growing for Singapore, it takes a very slow second half in order for us to move towards the range of 0 to 2%.
Yeah, so
full year target. Yeah.
The tariff rate 10%. That's what was the latest as we went by the baseline, but of course that's still up in the air. So we talk about front loading of the so-called economy, and then you might see a moderation. So looking at the markets, we saw record highs for the STI in recent days and on Wall Street as well. Was that also in some sense front loading, or will that also moderate?
There's partially some sense of the front loading as well, because Singapore's GDP in the first half did pretty well, above the 4% mark. So market was reacting to that. But more importantly, it was also that as market was moving away from the US as well, some flows of funds, they are looking for the next better value region, and that is Asia. So it's not just the STI, but also quite a lot of indication that there has been stronger expectations in the Hong Kong as well, and also in China. So we've been seeing year-to-date double-digit growth in the Hang Seng Index and also in the Chinese indices. So these are certainly some of the funds flowing from the Western world into this part of the world as well. But one key thing to note is that investors are slowly getting a little bit more worried that, particularly in the U.S. equities front, that things are tearing away from the warnings of policymakers that the second half could be slowing. So at the end of the day, while we do not know exactly when, but there should be some form of profit taking away from the table in the U.S. equities as well.
Yeah, it does look like there are still a lot of moving parts and things to worry about. Some of the latest data, including from China, paint a more pessimistic picture. Chinese households became more pessimistic last quarter, and their view of the jobs market fell to the worst ever, according to a PBOC central bank survey. So it does look like there is some growing risk of a slowdown ahead. So with that in the backdrop, how are you approaching markets right now?
Certainly, that observation is also corroborated by some of the evidence coming from the stock indices in the PMI numbers in China. In terms of producers' prices, is also below the expansionary zone of 50. In terms of labor, that is employment. That means that overall manufacturers are more pessimistic on the upcoming few months ahead of them, and causing them to be more concerned in hiring people. So I'm certainly afraid that this concern will bring about a slowdown in the labor market and generating another vicious cycle of slower consumption. And consumption is still quite a big part of the GDP in China. And that slower consumption may generate another part of this vicious cycle of slowing expectations of economic growth. So this is one key thing that if left to free market forces, it may indeed turn into this vicious cycle. So that's exactly what policymakers in China have been doing. Right now, I mean, they're talking about anti-involution because now we have been seeing a lot of price competition in China, be it your delivery platforms or even in the production of EVs, electric vehicles. Everything seems like the prices have been going on the downtrend. Although that's good for consumers, but not too good overall if things are on the deflationary front. Because at the end of the day, if you are a consumer and you believe that, if I delay my purchase, tomorrow this particular thing that I want to buy will be cheaper, and you're going to wait until tomorrow. But the act of you waiting until tomorrow and not spending today causes the slower revenue growth of these manufacturers or the companies. And that slows down immediately the immediate term or immediate quarter of GDP. So this is going to be quite a vicious cycle that the policymakers are now trying their best to go anti-cyclical.
Lots to look out for. Hopefully glass half full for the rest of the year. And we've been in conversation with Francis Tan. He is the Chief Strategist for Asia at Indosuez Wealth Management. Francis, thank you so much for your time and insight. It's always great chatting with you.
Same here. Thank you for having me.
All right, talk to you next time. Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.